super excited to have you on for this one and to talk
Thank
about
you.
a momentous day in this market. So we had you on recently, about a month ago, and we discussed a lot going on in the market. And since then, we've seen viral moves in Bitcoin, Tesla, Palantir, a lot of the names that we discussed. I would love to turn over the mic to you first to hear your thoughts on everything that occurred today, FOMC decision, as well as these earnings releases, if you've had a chance to look at them so far.
Well, yes, I'll give you my first take. Now, I'll explain that I'm in Germany and it is 10:30 at night, which is not at all a problem. But I was in transit when a lot of what happened today happened. I did catch, actually, Jeff Gundlach, whom I admire quite a bit, on CNBC and read a little bit of what the Fed said. He characterized it as, basically, pause here for a while. Inflation isn't where we want it and we can wait until it goes down. Pleased with growth, all of that. I actually think, we've been, trained to expect and want interest rates to go down. Short-term interest rates I'm talking about here. Short-term interest rates to go down. And he was calling them restrictive. Now, I'm going to take us two places here. We're at the beginning of a transition to a new administration. They are proposing policies that I think are very exciting. Deregulation critical, getting rid of Gensler and Lena Khan and so forth. The tax cuts, there are going to be questions because we have to get Congress behind them. The risk to the economy in here, I think, is that businesses and individuals defer economic activity until they see how low taxes are going to go. Now, the other side of that is we've seen a speed up in activity around tariffs, people trying to get to import goods and services to get ahead of the tariffs. So that happened toward the end of last year into the beginning of this year. And then we have maybe this uncertainty. So if confidence alone in this new administration is going to keep activity going, short rates may be at the right level. Short rates at this level are not bad if the economy, the real growth in the economy is going to accelerate. I think a bigger question is long-term interest rates. And after the Fed cut, as we all know, rates went up, long rates went up 80 basis points. And there was a lot of talk about the deficit and out of control spending, and Trump's a big spender. I think with Musk at his side and with the people he's surrounded himself with, that we are going to see surprising discipline. Now, Jeff Gundlach does not believe it. He'll believe it when he sees it. I tend to be a bigger believer just because we know Elon Musk, all of us on this call who follow Tesla so closely. And I think he's going to do amazing things, bringing productivity into the government sector with AI, importantly, a big part of it. So I think Jeff Gundlach, he's not following technology as closely as we are. And I think he will be surprised. I think he'll be very surprised by inflation as it comes down, because increasing productivity is an antidote to inflation. Companies actually can cut prices there are a number of things they can do if productivity increases. They can increase their margins right away. Many people assume that's what's going to happen. But there are three other things they can do. We think they can increase investment in R&D. They can increase wages if productivity is going up, because output per man hour which is the definition of productivity, is going up. Or they can cut prices, especially if they're in a competitive situation. AI is very deflationary and productivity enhancing. They can cut prices to pass along some of the cost savings they're seeing. So we're really excited about what's going to go on out there. And if I didn't have to talk about this transition period, I would tell you short rates at this level, given the kind of acceleration in real growth that we expect in the next year or so, they might be at the right level. Long rates, we think, have discounted the deficit too much, we think, and they're not focused on the disinflationary, if not deflationary ramifications of these productivity gains and the incredible cost declines associated with artificial intelligence.
Not a problem at all. Love listening to your opinions and thoughts on this AI side of things, and especially pertinent today with everything we're reading through that Tesla's recently released. Speaking of Tesla, we've got two of the top accounts in the world that talk about it, Sawyer and Omar, on here right now. Sawyer, do you have any thoughts or questions regarding Tesla that you would like to ask to Cathie?
Yeah, sure. Hey, Cathie. It was great to meet you and the ARC team at the Robotaxi unveiling.
Yes. Thank you, sir.
Yeah. So in regards to Tesla, in the last few months, I feel like there's been a narrative shift on Wall Street's part away from vehicle deliveries to sort of now more focusing on FSD, AI, and to a lesser degree, maybe Optimus. And you obviously talk to a lot of Wall Street types. In your experience and discussions, do you find that Wall Street has sort of finally woken up to the long-term potential of Tesla's FSD and the incredible progress that they made in the last 9 months? Or do you sort of feel like they still have their heads in the sand?
I think what's happened very recently is auto analysts, and I think the coverage still is predominantly auto analysts. We're getting more and more tech analysts in, and those are the right analysts, either robotics analysts or AI analysts or energy storage analysts, all of those. I think what's happened is auto analysts have said, okay, this resembles nothing else that I am following, which has been true all along, by the way. They just thought they understood electric and autonomous. And of course, they don't. They're expert at the internal combustion engine. So I think there's a little bit of like, oh my gosh, I've been pretty wrong on this. There are some people who are stalwart there still, which is kind of unbelievable. And now they have to face the prospect of modeling in autonomous. And I know I'm a little hamstrung here, but I know that Tesla started out after the report down 5% plus, and I don't know if it's still up 4% plus. But I do believe, the idea that Elon reinforced that Tesla will be scaling the Cybercab in 26 means production has to start this year. And I think the work we're doing in our Big Ideas deck will be out next week. And in it, you'll see, we can see Tesla getting down to, in the next few years, a $15,000, I should say this is a 5-year forecast, so $15,000 car. Again, this is nothing that traditional auto analysts can relate to. They've only seen their prices going up, the prices of the autos they follow going up, especially with more and more regulations over time. And they're not enjoying the cost declines associated with new technologies. So I think, and I hope we have put out our autonomous model and our 5-year model. We did that close to mid-year last year, and we stand by it. I hope more and more people are looking at it. They can look at it and test. And if they don't like our assumptions, I think there are 40 variables we allow people to change and see how the price target changes from our 2600. So I think more and more people are starting to experiment with it. And there are some analysts out there, more on the tech side, who really do understand. And I think they are gaining more traction. I think the broadcasters, CNBC and others, are inviting them on more. And again, this is increasing the efficiency of the stock price.
Great question there, Sawyer. Appreciate that. And love the content that's coming out here. And I encourage people to take a look at Cathie's timeline, Sawyer, some of the others, if these are topics that you want to continue to dig further into. We also have Omar from Omar's catalog up here. Omar, did you have a question here?
Sure. Yeah. Thanks for being here, Cathie. Great to talk to you. I was just wondering, with a lot of the conversation recently about generative AI and sort of the commoditization of LLMs, how you really view generative AI as a business versus the sort of real world AI Tesla is doing. Do you think it is defensible long term, or is it sort of destined to be commoditized, much like what we've seen in the LLM space?
Well, it's a great question. Our highest conviction AI names are, as you say, Tesla is the biggest AI project on earth. One of our highest conviction names. I would say if we're looking at other AI, and I am talking about generative AI applications here, we think the most profound applications are in the healthcare space and, the convergence of sequencing technologies. I mean, I think people are astounded to learn that we have 37 trillion cells in our bodies. A lot of people focus on 20,000 genes, but we have 37 trillion cells in our bodies. And there is something called single cell sequencing out there right now, along with DNA, RNA, protein, methylation, metabolomics, a lot of other sequencing technologies. That is just the biggest data project in the world. It's bigger even than Tesla's, and Tesla's has been the biggest data project in the world thus far. So we're very excited there. We think the inefficiencies in healthcare around the names that are capitalizing on the convergence of sequencing technologies, artificial intelligence, and CRISPR gene editing. Those inefficiencies today are as big, we believe, as the inefficiency in Tesla in 2018. And believe me, we are spitting in the wind at this. I mean, nobody in the healthcare space is giving this idea any oxygen at all. But our conviction is growing, and you'll see in our big ideas report next week how provocative this is. It's been really tough in our flagship category fund, ARKK, to keep we call them multi-omics names, up in the 20 to 22% of the portfolio because they've so underperformed. But I think the inefficiencies in that space are as big as the inefficiencies when we were taking on all the bears in Tesla in 2018 and 19. In terms of the commoditization of the space, well, I do think this is DeepSeek week, all right, and been getting a lot of questions here in Europe about it. What we believe is that DeepSeek is while everybody seems shocked by what they've just done, and we're not quite sure that they did it, but we'll see longer term. The model itself is as performant as OpenAI's O1. However, it purportedly cost somewhere between a 10th and a 20th the cost of the large language models that are evolving out there and approaching $100 million per model. So they say $6 million. Now, we don't know what they included in it or not. But if you look at our work over the last, really, we started following AI and modeling it in 2014, which is when we first bought NVIDIA at 40 cents a share. And as time has gone on, we've been able to discern the learning curve associated with AI. We use Wright's Law, and the learning curve, we've built it around the combination of hardware and software. And the metric was really hard to get. It's a metric of data per unit of computing power. And if you look at the cumulative doubling of that metric, for every cumulative doubling in that metric, costs have dropped 48%. But the very provocative, the aha moment for us was that the cumulative doubling in this space is happening in less than a year's time. So that AI training costs have been dropping 75% per year, and AI inference costs have been dropping 85 to 90% per year. So it's going to take us, if let's just say DeepSeek was on something here. Maybe they're a little bit off on that learning curve, but it's not going to take long because we're talking mostly about inference chips here. it's not going to take long for us to get to wherever they are now because costs are dropping 85, 90, 95% per year. It's really provocative. So that's the first thing I say. I think, I think the nuance here is if you're thinking about NVIDIA, and I'll get back to the commoditization after this as well. The nuance here is this is a reasoning model and it's much more reliant on inference chips. That's a more competitive category. You've got Grok, G-R-O-Q, out there, and they are commoditizing. It is their mission to commoditize the inference chip space. They're doing another funding round right now, so we've been speaking with them, learning a lot. Jonathan, who's the CEO, will be very quick to say, as he did upon the release of DeepSeek, he says, yes, we are focused on inference and there are much lower margins. It is much more competitive space than the training space where the economics really are strong. And NVIDIA has had, 85, 90% share of that market. So he's quick to say, you need training, you need both sides. But what does seem to be happening is these models are going to tip the scales towards inference. There is a lot of competitive activity on the chip side from the hyperscalers themselves. And the reason for that is you've got NVIDIA's gross margins in the high 70s. And you've got the cloud companies' gross margins, we think, they don't give us all this information, somewhere in the low 50s to low 60s range. So these hyperscalers have a huge amount of cash to reinvest. And if one of their suppliers' margin structure is higher than their own, well, they have a big incentive to invest there. Amazon has Trainium and Inferentia. Google has the TPU. Microsoft and Meta are designing their own chips, but they're also helping AMD with the software side of this business. So NVIDIA's calling card has been CUDA software, and it is able to handle all of the frameworks out there. It was 13. I think it might be 15 now, whereas most of the others are much more specialized to just one or two frameworks. Well, if you think about that too, what is AI especially good at doing? It's coding. And so if there are 13, 15 different frameworks out there, and we are moved, if you look at the SWE benchmark, coding agents now can be given a job and complete more than 75% of it. And if you're using Replit, we're hearing sometimes 80%. And more without human intervention. So won't it be a little easier now to convert to all of those frameworks? I'm probably throwing too much at you, but there's just so much going on in this space. And in terms of the cost coming down for the users of AI, this is amazing. And well, I know that the big controversy this week has been, wait a minute. And this may be changing now. I don't know if Meta's out yet. It wasn't when we were starting this call. But, before DeepSeek, Zuckerberg came out and said, yep, we're going to spend $60 to $65 billion in CapEx towards data centers, AI, everything, including power. Microsoft, I think it was 80 billion, if I'm not mistaken. So these are big, big jumps. And they may have committed to GPUs, which I always look at a space. And when I see double ordering, triple ordering, a frenzy, no one can get enough, I usually believe there's going to be a big inventory problem out there somewhere. Now, DeepSeek, if what they're saying is real, and if we are now doing more on the inference side, maybe there will be too much in the form of inventory for NVIDIA. This all remains to be seen. We just have to learn more about DeepSeek. And one other thing I'll say, I saw Microsoft came out and trying to discern what the currency impact was. But, Microsoft's revenue growth, from what I can see, decelerated. I think it's gone from 17% to 16%, and to 12% is what I saw might be with currency a little higher, when you adjust out for currency, a little higher. And that's the true underlying growth, let's say 13%. But that's a slowdown. And in the work that we've done on the software space, we think that software growth should accelerate. All parts of the tech stack, the growth rate should accelerate. Why is Microsoft's growth slowing down? What is that? So, again, we're going to be looking, and ServiceNow apparently, and again, I'm just catching snippets, but they're going from a subscription to more of a usage-based model, I think. And so they're cutting their revenue growth. The revenue growth is decelerating. And, maybe it's going to take a while for the growth to turn back around, but we need to investigate what's going on here.
I love it. Cathie, I know it's getting late over there by you, and I really appreciate you making the time to come and speak with us. We're going to take one last question, if that's okay, and then we'll wrap up with you.
Sure. Great.
Amazing. Stock Talk, I'll turn it over to you.
Thanks for being with us and appreciate all your commentary as always. I was actually going to ask you about your thoughts on inference versus training and how that would affect compute supply and investment in compute, but you sort of already answered that in your initial question. So I'll ask you about something else that I've always kind of been curious about your opinion on. I know, ARC and your research team have been very involved in the clean energy space, obviously via Tesla, but via other stocks as well, especially during the SPAC era. What I haven't heard you talk a lot about is nuclear energy. And I'm very curious about your thoughts on the role that nuclear might play in this next generation of technology, whether or not we think this data center theme might be as big as some people do. What are your kind of thoughts on where you see nuclear energy? What exposures ARC might be looking to have to that theme, if any?
Sure. Now, in one of our more specialized portfolios, ARKQ, which Tesla is its largest position, the name of that fund is Autonomous Technology and Robotics. So in that fund, we have been buying nuclear names. In fact, we got into Cameco early last year. We got into Oklo when it had been really beaten up, and got to meet that management, learn about their small modular reactors. And so we've done pretty well trading that one. BWXT, the old Westinghouse, we have initiated a position for it to migrate into the bigger funds. We had, it was starting to get so hyped that we said, okay, we have a choice between buying a genomics name that's getting trashed or a hyped nuclear name because of data centers. And so we've been focused more on the multi-omics genomics space, but we have very high hopes for nuclear. In our big ideas next week, you will see a lot more on nuclear. Sam Corris and Daniel McGuire have been spending a lot of time on it. And one of the most provocative things about nuclear is regulation arrested that technology cycle. The regulation took place in 1974 in what was Japan and the US. One of them was 74, one was 78. And you'll see the cost curve, which had been falling. This is a cost curve, Wright's law associated with new technology, had been falling, and regulation, whether it was for, environmental concerns. Of course, now environmentalists like nuclear now. It's crazy what's happened over the last 50 years. And then, of course, we had Fukushima. So there were all kinds of, and I used to come here to Germany. I couldn't even talk about nuclear, but we had done a big black book at AllianceBernstein. In fact, Brett Winton, our chief futurist, was the author. And he deemed it, and it is true, it's the cleanest energy source out there, except for perhaps hydro. So you're going to see, the punchline is, if they had not regulated, and you'll see how much the costs have gone up since they have, electricity prices today would be 10% of where they are now. That's how much they derailed that technology movement. And so we believe that with this administration, we're going to get back on track. And we do have very high hopes for nuclear. As I said, we did this black book. It was very frustrating. We did the black book, finished it in 2010. and started going out on the road. And then Fukushima hit in 11, and there was the end of that. So we know a lot about nuclear. We've been doing research on it for a long time. We do believe that this is the rebirth of the nuclear age. It had to be jump-started by the data center demands. But we think as more and more analysts and environmentalists study what this technology is all about, they'll see how wayward the last 50 years have been. Government regulation is a menace if it is not for our national security and our safety. They might have thought it was for our safety, but they were regulating. They were wrong. Sure, we had the nuclear accidents, and that was terrible, but they were extrapolating that into a monster, which we do not believe will exist. And again, we're very optimistic.
Beautiful. Cathie, I always appreciate the passion and the vigor with which you speak, combined with the detailed analytics and the experience that you come to the table with. Thank you so much for, on a travel day, late at night, over in Europe, Germany, taking the time to come speak with us. We really appreciate it. And I know that we're hoping with your team to set up a space maybe in a month or two to talk on the venture side of everything that Arc is doing with Dr. Charles. So I'm really looking forward to that as well. Yeah, my pleasure. Thank you again for coming on. Encourage everyone to give Cathie a follow if you're not already.